Hello and welcome to the Hot Forex latest video on the basics of trading Forex. My name's Stuart Cowell, I'm the Senior Market Analyst here at Hot Forex, and today we are going to run through some basics of Forex trading, some key terms that you all should know. So in this video we're going to cover 6 key words and terms, everything from account balance to equity, the difference between account balance and equity. Many people get that confused. Leverage, very important subject, again misunderstood and gets confused with many people, and also the margin and the different types of margin that can be applied to a trading account. And finally we'll look at the value of a pip and what a pip is, and lot size, trade size, volume, all the same thing, called different things with different applications sometimes. So let's get going. So first two, the balance of your account. The balance is quite simply the cash that's in your account. The account balance goes up and down as you close trades. The confusion comes in when people see that their equity of their account, and equity simply goes up and down with your open trade. So if you're winning trades, your equity can sometimes be bigger than your balance. Losing trades, be smaller than your balance. So equity equals your balance plus your open positions. So if your open positions are in profit, that could be your equity is bigger than your balance sometimes. So graphically it can look like this sometimes. So here we have the blue line with the account balance of this particular account drifting down over time, and the equity, the green line, above the balance here for some time and then below the balance towards the end of this period. Okay, so equity and balance, two different things. Balance is the cash in your account, and equity goes up and down as your trades are open and they move from profit to loss. Okay, next most important area I want to look at is leverage and margin. Okay, as I've written here, two of the most misunderstood and misused terms in trading. And many people think they're the same. They are not the same, and it's important you as a trader understand what they are. Leverage can be both good and bad. That's the old cliche that people talk about leverage, but you can see how it allows you to take trades that you wouldn't normally be able to. That's the good side of leverage. So leverage, what is it? Well, the dictionary calls it the use of credit to improve one's speculative capacity and increase the rate of return from an investment. So in simple terms, leverage is all over the financial business. Okay, many financial instruments use leverage. So for instance, if you were buying a house, for example, and this house cost $100,000. To do that, you normally take out a loan or a mortgage from a bank, but the bank would expect you to put some sort of deposit down. In this example, we're going to look at a 20% deposit. So you come up with 20% and the bank loans you the remaining 80%. So here your leverage is 1 to 5. So you've put down 20% and the bank has lent you the remaining 80%. So you've leveraged your $20,000 to be able to help you buy the £100,000 asset, the £100,000 house. So you have 5 times the purchasing power of your initial deposit, and that's what leverage is. It gives you greater buying potential power. Okay, so a leverage of 1 to 50 in this example would mean that your $20,000 deposit would allow you to buy a house for $1 million, and that's how leverage works, and it's all across all financial instruments. And for some reason Forex traders can find it quite complicated. And in simple terms, it's a bit like this crane here. The crane moves a small movement here at this end, but the lever at the end of the crane moves much further, doesn't it? So that's what leverage is. So a small movement here at this end can cause a much bigger movement here at the other end of the crane. And that's exactly how leverage works, both, as I say, both positively and negatively on your account. And it's very different to margin. Okay, margin is a deposit in that house example we've just looked at. So the $20,000 deposit is our initial margin. It allows us to buy the house. If we didn't come up with that deposit, the bank wouldn't forward our loan, would it? It wouldn't give us a mortgage. So our $20,000 is, it's a good faith. It's our deposit to be able to to leverage that amount to allow us to buy the house of our dreams. So the Forex market works exactly the same way. Your deposit allows you and your broker to release the rest of the funds to allow you to trade. So margin is the deposit and leverage is the loan element. So don't get the two things confused because they are very different. So margin and leverage, two different things. The other thing that confuses many new traders and indeed more experienced traders are different types of margin that are the different words that are attached to the word margin. So let's just run through them quickly here. So initial margin, the amount of money required to open your position. So it's like your initial deposit, the amount of money you first put in your account. So it says that's my deposit on my account, and my broker will apply a leverage to my account to allow me to use, leverage those funds and be able to trade larger lots or larger margin sizes. So when you actually open a position, the margin becomes the money that's locked up to keep your current positions open. So the money is still yours, it's still in your account, but the broker needs it so that you can, if you have to close out the position, you get the money back if you're in profit. If you don't, it's part of the loss of the trade. So free margin is the difference between the equity and the margin that you've already got locked up. Okay, and the margin level is the margin, the amount you've got on margin divided by the equity, and it's always expressed as a percentage. Okay, so here, this is just from a demo account of ours. So here we've got the balance here that we just mentioned before. So the balance here is 70,936. The equity is less here. It's 70,400. So the balance and the equity is about 500 difference, and that's because that's the positions that are already open. The margin, the positions that are open are down by 520. So that's the difference here between the balance and the equity, and the margin of these open positions that are actually in loss at the moment that's tied up is this 846. So the free margin here, free margin is equity minus the margin, so equity 70,400 minus the margin here, this 800, leaves us this 69,560 level here, and the margin level, this 8,300 percentage, is the margin here, 846, divided by the equity, 70,400. So that's what these three levels explain, and you'll see these at the bottom of your MT4 account as well. And finally, a margin call. This is when the amount of money in your account cannot cover your possible loss. So it happens when the equity here falls below this margin level here, and that's a position you really don't ever want to get into. And this account is obviously a very healthy one because the equity is 70,500, the margin's only $800 here. So if a margin call occurs, some or all of your open positions will be closed at the market price. Okay, so you really want to avoid a margin call. Okay, so let's have a look at some examples. We've talked about the house purchasing, but let's bring it into the world of Forex and look at leverage and margin working together. So here, these couple of worked examples, we're going to look at leverage when there isn't any, so one-to-one, and just show you how leverage helps you take positions and how it can help you make better returns. And this margin of $1,000, the initial margin, the deposit in the account of $1,000. So in this example, we've got the dollar yen USD JPY, and the current rate is 112.50. So what this means is that $1 US equals 112.5 Japanese yen. So in this first example, we're going to use a leverage of one-to-one or no leverage. Okay, so here our $1,000 allows us to buy 112,500 yen. So we've sold our US dollars to buy yen, so in effect we're short this currency pair, the US dollar JPY. So we've used our $1,000 in our account to buy the equivalent in Japanese yen, which at the moment is 112,500. So we've sold our dollars to buy yen, so we're short the USD JPY. Sometime later, so that's our open trade, so sometime later this rate, the USD JPY rate, moves down to 112.00. So what does that now mean if we sold our position now? We sold our 112,500 yen. Well, what we do, we sell our 112,500 yen, and the rate now is 112, so we divide our 112,500 by our rate, 112.00, and that returns us 1,004.46 cents. So $1,004.46. So on this particular trade, where the rate has moved from 112.50 to 112.00, we've made $4.46 without any leverage, or a return of less than 0.5%, 0.446%. So as I say here, it's not very exciting. However, it gets a bit more exciting if you had a bigger account. So if you had $10,000 in your account, that $4.46 becomes $44.60, which is, okay, not great. But if we had $100,000 in our account, which is the same as trading one lot, which we'll talk about in a minute, that $4.46 becomes $446, which is a bit more interesting, isn't it? When we've had this small move in the rate from 112.50 down to 112. So that's with no leverage. So we made $4.46. If we applied a leverage of 1 to 100 on that account, we had exactly the same scenario. So with a leverage of 1 to 100, our $1,000 allows us to buy 11,250,000 yen. Same situation. The rate moves down to 112. Our 11,250,000 yen divided by the rate now makes us 100,446.43 cents. So in this example, we've made $446.43. But more interestingly, and more importantly, this is the power of leverage. Our $1,000 here with a leverage of 100 means that our actual return on our $1,000, $446.43, is 44.64%. Very, very powerful leverage. And on the flip side, the other side, this could also have been a loss if the rate had moved a similar way. So that's why leverage really is a double-edged sword, and you really need to understand how it works both for you and potentially against you if the rate moves against you in your open position. So a very powerful financial instrument, but you do need to be fully aware of it and manage your trades accordingly. So finally, the two final little points I want to bring out again: pips and volume. So pips in Forex terms, currencies are always quoted by the pip, and currencies are always quoted in pairs. And that when we invest or buy or sell, the volumes are known as lots or a trade size. So most currency pairs, you will see the pip value is the fourth place after the decimal point. So here, for example, the Euro USD has a price of 1.0645, and the number 5 here is the pip value. So if the price rose by 10 pips, then the price would become 1.0655, and if it fell by 15 pips, it would become 1.630. So the pip is the fourth number after the decimal place, and that's the example for most currency pairs. However, the one exception is the Japanese yen. The Japanese yen is always quoted to the second place after the decimal point. So in our example before, where the USD JPY moved from 112.50 to 112.00, the rate had moved by 50 pips. Okay, so the Japanese yen is always quoted to the second place after the decimal point, and all the other currencies and most of the other major currencies are quoted to the fourth place after the decimal pip. That's the pip value. Okay, and finally, the other thing you should really understand as well is volume or lot size or position size. They all mean the same thing, but again, you must understand how important this is when you combine it with leverage and the margin on your account to make sure that you're trading in a very safe way. So many people get this wrong and end up trading lot sizes that are too big, and that's why often they fail, or they risk too much, or they don't invest enough in their account to actually deal with the level of risk they're taking on. So be very careful of your lot size. So typically the lot size is shown here when you open a position. So this is a full lot, mini lot, and micro lot, and we'll have a look at that on the next slide. So be aware of the size, the volume that you're taking on. So one standard lot is equivalent to $100,000. That's the rule. So one standard lot, 1.0 here, is the same as 10 mini lots, or 0.1 here, on 100 micro lots. So you can quote with a small account, you can trade very small amounts, and it keeps you, can keep you quite safe. So $100,000 is equivalent to one standard lot, which in the Euro USD pair would mean that each pip, we've talked about before, each movement in the fourth point here would mean $10. So every time this went from 39 to 40, for instance 39 went to 40, and you were trading a full lot, that would have made or lost you $10. Okay, if for the same pair you were just trading a mini lot, 0.10, 1/10 of a lot, that's equivalent to $10,000. So instead of it being $10 per pip, it's $1 per pip. And at the entry level, the micro lot, which is 1/10 of a mini lot and 1/100th of a full standard lot, that's equivalent to only $1,000. So each movement of the fourth decimal place after the fourth point after the decimal place, the pip value, each pip is equivalent to 10 cents. So 1/100th of a standard lot. So here is where you should be starting, and you look at standard lots when you have a good size account and good levels of experience. So I hope that's been helpful. More to come, and any questions, please have a look on our analysis page, analysis.hotforex.com, and I look forward to speaking to you again soon. Take care. Bye bye.